Hey guys, Whitney here. Welcome to the Passive Investing Made Simple Masterclass. I'm your host, Whitney Elkins-Hutten, Director of Investor Education here at PassiveInvesting.com. And I'm so excited that you're here with us every Tuesday. We record this show live so you can learn the ins and outs about passive investing and go into your next deal with confidence. And so if you haven't done so already, make sure to check out PassiveInvestingWithWhitney.com. There, I've got some free goodies for you. A free ebook and checklist on things to look out for as you're going into your next passive deal. And you can also see our open deals. Again, check out passiveinvestingwithwhitney.com. Now, I am so excited to bring on a special guest today, Zabriskie, with Money Insights. And Rob, welcome to the show.
Hey, thank you so much. Glad to be here.
Yes. All right. Well, we are going to talk about cash flow life insurance today, but I'm so excited about to discuss the spin on that particular product. And so first, but before we dive into that, today, Rob, why don't you tell everybody a little bit about yourself and how you got into this space?
Yeah, absolutely. So, like I said, I'm the president of Money Insights, and I've been in, as it relates to this space, like I've been in the insurance space for, man, 15 years, and time flies. As relates to just like passive investing, when I was in college, I read Rich Dad Poor Dad, and I was in. I read Cash Flow Quadrant, got kind of the whole picture on it, had these dreams of creating passive income, becoming my own, owning my own business, investing in real estate, doing all of the cool things. And it's been a journey. As with anybody, there's a learning curve. There are a lot of different angles to it, different ways that you can do it. And so I guess for my personal journey, that has included becoming a business owner with my partner, Christian Allen, forming Money Insights and doing some cool things there that we'll talk about today in terms of how to enhance the return that people can get in their investing. But that's really my passion. I love being in the alternative investment space, whether it be real estate, whether it be, whatever. There's the cool stuff that we can do here that you can't do over on the kind of the traditional space. I just always get really excited about it.
Excellent. Well, Rod, thank you so much for joining us. And I'm excited because we had the conversation a couple of different times about infinite banking concept,
Yeah,
which does utilize a cash flow life insurance type policy.
right.
But, I'm always looking for ways to help investors understand how they can use these different tools and especially try to maximize their investing potential with them. And so let's start it off there. Let's first talk about what a cash flow life insurance policy
Sure.
is, and then maybe how your unique spin differs from infinite banking.
Yeah, great question. So, cash flow life insurance or cash value life insurance or permanent life insurance, there's a few different names for it. But essentially, what we're doing is we are utilizing the benefits or the values that we can get in with life insurance that you can't get anywhere else and just applying them in ways that makes our investing better. And so if you're hearing this for the first time, you might be thinking, man, life insurance of all things. And I totally get it. That's exactly what I thought the first time I heard even the idea. And so specifically, when I talk about the kind of benefits that we can get out of it, we're able to create inside of a life insurance policy, especially what we're using is whole life in this case. With the whole life insurance policy, you have an underlying account value inside of it, right? And what we're doing is we're building it in a way very specifically to make most of that cash value in the policy to make it grow in significant ways, and we have access to it. So more specifically, we can create roughly a 5+% return consistently ongoing. We were getting the 5% 3 years ago, or we're getting the 5% today. And moving forward with it with higher interest rates, then we actually expect that will go up a little bit. But it's just consistent, very, very consistent. That growth is tax free. So you might have to get, 7 or 8% in a taxable place to match the 5% here. But what we're not saying is we're not saying put all your money here so you can get this really cool 5% return, because that's not sexy, right? That's not what people are looking for. What they are looking for is the 10, 20, 30% plus returns that we can get in the passive investing world. And the fact is that we use this life insurance account as, I call it the opportunity fund, the place where I build up my account. I take that money, I go and invest with it. I funnel money back into that account to build it back up and go out and invest in something else, right? So, but there's nowhere else I can go to get that consistent return that's tax free and it's liquid. I can access it and use it when I'm ready. The deal comes, I'm jumping on it. I'm using the money to go and do that. And there are some other specific like flow things that we'll get into here in a minute. But just a package that I can't get with other things. And that's what we're talking about when we talk about this kind of cash value, cash flow life insurance.
Mm. And well, let's dive into that a little bit more. And then I
Yeah,
really want to kind of draw out the differences between what you're talking about and then how this differs from what, most people here in the industry, which is infinite banking, because there
sure.
are some distinct differences. So, but I think to kick this off, when you and I were speaking on, before the show, that there's actually 6 core benefits here that anybody can take advantage of when it
Yeah,
comes to opening up a cash value or a cash flow life insurance policy. What are those 6
right.
benefits?
Yeah, it's a great question. In the money insights world, we have what we call the invest with benefits philosophy. And essentially what we're saying is if you're going to invest anyway, you might as well invest with benefits because there are certain things that you can get out there that make your returns better. We can build wealth better, get to that place of financial independence more quickly. Excuse me. And those 6 are leverage, velocity, cash flow, tax optimization, asset protection, and estate maximization. And to the extent that we can capture those core principles as part of this invest with benefits philosophy, we want to do that. And we can do that with a lot of things, right? When we invest in real estate, right? We're getting most often we use leverage, right? Velocity just means we're trying to turn our money over as quickly as possible to get into the next deal. And there are a lot of things in real estate that do that. Cash flow is big, the tax optimization is big, asset protection, we structured in a way to do those things. So what we're saying is with with the things that we do, and so in this case, what we call the investment optimizer in particular, we're using all 6 of those things, all of those principles to maximize, to make the most of the investing that we're doing.
So how do you do that?
Yeah, great question. Okay, so let's just kind of build a scenario. So let's say that that I'm someone who likes investing in the alternative space. I'm setting aside X amount per year. Let's just say it's $100,000 a year that I'm setting aside for my investing. Okay. Instead of just putting that into a checking account or a money market account, what I'm going to do is set up one of these specialized life insurance policies so that I can put that $100,000 a year into that policy. So I do that. Now I have cash value in the policy and it's there, it's earning, it's growing. And I mentioned earlier 5%. Well, how does that work? Well, basically, I'm earning a guaranteed interest rate, which right now with most of the companies is right around 3% guaranteed interest. And then in addition to that, we're using specific types of companies that give us a dividend. In other words, as a policyholder with the company, when they declare a dividend, because I'm a partial owner of the company, I get a portion of that dividend. So again, depending on the company, you might be seeing a total of 5.5 to 6% between the guaranteed interest and that dividend. Okay. So therefore, when you factor in costs and whatnot over a long period of time, that's how I mentioned earlier, we can get to about a 5% net return after considering all those costs. Okay. So the money goes in there, but again, my purpose isn't putting in there. It's just what stays there. I want to actually use it. So I have a deal come up. Let's say I need whatever, 70 grand to go and put as a down payment on a property or put into a syndication or something like that. Then what I'm going to do is I'm going to access that 70,000 through my policy, but I'm not actually going to remove the cash out of the policy. What the insurance company allows me to do is they have what they call a loan provision. In other words, because I have my cash sitting there in the account, I have access to a much larger bucket of money, the general account of the insurance company. And so I'm going to take a $70,000 loan using my cash value as collateral for the loan. They drop that 70,000 into my bank account, but my money stays in that cash value and continues to grow. Okay. So this is the beauty of, we talked about leverage as one of the principles, right? I'm using OPM, other people's money, right? Same ways we do in a lot of ways in the alternative space. So my money stays there, continues to grow. I now have the 70,000. I use that to go and invest in the syndication, where I'm maybe creating some cash flow and some different things, hopefully a big liquidity event in the future. And so my money is actually working for me simultaneously in two places at the same time, because of the way that the loan provision works. So I put the investment in. Now it starts creating some sort of cash flow. Let's say I get an annual distribution or something. I take that annual distribution and I put it back towards my policy. Now, technically speaking, what I'm doing is I'm paying that towards my loan. But strategically, what I want to do is I'm putting that back there again, not to leave it there, but to build it back up so I can go back out and invest in something else. So the flow is exactly the same as it would have been had I been using my checking account. I build it up there, use it to invest, flow it back in, build it back up, go out and invest in something else. But the power of that is that now I'm getting the benefit of, again, my money working for me in two places at the same time. I'm continually getting that consistent compounding growth inside of my cash value, and that's tax free, right? And I'm doing all the investing that I was going to do anyway.
And so how does that, I guess what when an investor or listener here is trying to evaluate, oh, if this is for me, you know, how does that pencil out to an added return to their
Sure.
particular investment?
Yeah, so we've done a lot of analyses on some different ways to invest, and we've put those in some webinars, and so you can go check that out. Investwithbenefits.com. We'll talk maybe about a little bit more about that in a minute, but let me just give you one example. Some people may be familiar with an ATM deal where you can put in some cash. That money is used to go out and place ATMs that then creates cash flow coming back. It's a very consistent cash flow over 7 years. And when you look at the pro forma for that, the pro forma says that the IRR over the course of those 7 years is about 16.5%. Okay. So great, right? Kind of return that I'm looking for. I've actually invested in this ATM deal. But what happens is, if I'm investing with it using the investment optimizer policy, this what I described earlier with kind of flowing the money through that policy, because of the additional return that I'm creating in the policy, in addition to the 16.5% that I'm creating, and again, including all costs. So as I'm flowing the money back and I'm paying interest on the loan and there are different things happening, what happens is I turn that 16.5% return into a 20.8% return. So solely by the way that I flow that money in and out of that deal, I've actually, just by doing that, increased the return that I'm getting off of that investment.
Mm-hmm. Okay. And so most people here are actually investing in passive real estate. What would be an example of the way that they could boost the returns there?
Yeah, so it would be a very similar thing. So again, there are a lot of different ways that these investments cash flow, but let's just say it's you invest in a syndication that's kicking off some sort of quarterly or annual return. Okay. And maybe there's a 5-year cycle or something where there have been improvements on the property, the value goes up, there's a sale or there's a refi or something like that, and then you're getting your cash back, right? And over the course of that, let's say that your annualized return is 20% or something, right? Well, a similar thing would happen. So you're getting the 20% directly from the investment itself. And because you have this additional layer, this kind of foundational piece of the investment optimizer, you would add an additional 4 to 5% above the return that you're getting. So instead of thinking of it in terms of a 20% return, it might be a 24, 25% return.
And what's the impact of that additional percentage, even if it ends up being just a couple of percentage points, like
Yeah.
over, say, 15, 20 years?
Yeah, it's a great question, because in that 20% example, if I can turn 20 into 24, then that extra 4%, it's not a 4% increase, because if you look at it in terms of a 20, right? Well, 4 goes into 25 times. So that means I increased my return by 20%, right? Meaning turning 20 into 24 increased my return by 20%, right?
Because you had leveraged.
right, but through
use
the
leverage.
leverage, I'm creating value in this other place at the same time. And so again, instead of somebody getting a 20, if they're getting a 24% return, then they're getting a higher 20% higher return than from where they started. Right.
Kind of seems
So
like buying a rental property.
yeah, I mean, it really it is, and so that's why we go back to those kind of core principles, and again, leverage being one of those, cash flow being one of those, tax optimization being one of those. So it's very much within the mindset of the passive income investor, because it's taking advantage of the exact same types of things that people are already wired to be going out and taking advantage of, right?
So we know leverage can cut both ways, though, helping
Sure.
us create wealth. What are the downsides here?
Yeah,
How
well,
can this, is there any impact? Like, should, interest rates go a different direction? Like,
yeah, it's a great question. The beauty of the particular vehicle that we're using with this, I mentioned specifically whole life, and some people might have heard that and been familiar with other types of life insurance. Okay, well, why not index universal life or variable universal life or some of these other things out there that have different ways of growing the cash value? And the answer to that is that index universal life can be used. There are people who use that product for it. The difference is, and the reason why we lead with whole life is whole life. I mentioned this earlier. The return is just very consistent, right? And so what that means is I have that money there. I've leveraged it to go out and invest somewhere, and I don't have to worry about what's happening in the way that the cash value is growing, right? It's just so consistent and so predictable. I know exactly what it's going to do. So I'm taking enough risk in the investing that I'm doing with the real estate or with these other things anyway, right? So, so really getting at the heart of your question, well, what risks are there with this? And the beauty of it is because in my earlier example, the 70,000 that I've used to go out and invest, I did take it as a loan, but it's fully collateralized by that cash value. So someone might say, okay, great, but what if that investment goes belly up? My 70,000 is gone. Now what? Well, the answer is, because the concern is, well, are they going to come after my house? Are they going to come after, like, am I going to have, creditors coming after me? And the answer is no, because it was a fully collateralized loan and you have options. Like you could say, well, I'm just going to take from the cash value then and pay off the loan and everything's good, right? Or in most cases, what happens is people have multiple investments that they put money into, right? The whole idea of don't put all your eggs in one basket. If that's one of several investments that I'm in, so I have the real estate, maybe I have 3 or 4 different properties, short term, long term, rental property, syndication property, ATM, or other types of cash flow things. And then the one deal goes bad, but the rest of them are still cash flowing. Well, I can use the cash flow from the other ones to pay off the loan from the deal that went bad, right? So most often that's the way that it goes. Again, because we're working with savvy people who are diversifying across different investments.
Mhm. Okay. Now, we kind of, and I don't think we clearly answered this question because
Yeah.
there are a lot of people out there that talk about, infinite banking. How
Yeah.
does that, and I know it utilizes whole life insurance as well. How does that differ from what you are proposing here?
Yeah, it's a great question. And that's most often when I describe what we're doing with the investment optimizer, the way I've described it here today, because a lot of people are familiar with infinite banking, they just assume it's the same. And admittedly, it is very similar. Like you said, it's using whole life. We're putting the money in there. We're loaning against it. So really, at its heart, it does sound very similar. I think the biggest difference is in the in the infinite banking world, they talk about using loans for all kinds of different things. Hey, use it to go buy your car and to go on vacation, and in some cases, even in extreme examples, even like pay your bills, right? So
Mhm.
put the money in the policy first, take a loan. And really what they're focused on in that case is with the money that's in the cash value and the interest rate that it's earning versus the interest rate that you're uh, paying or accruing on the loan. If we can create an arbitrage where I'm earning more than the interest on the loan, then just by virtue of having a loan by itself, I'm creating value, right? So that's kind of the crux of infinite banking. The challenge is that that doesn't always work. I'm not always going to be earning more interest on as an interest rate on the loan or on the asset versus the loan side. And secondly, it causes us to go down some kind of strange rabbit holes in terms of, oh, well, you can only get this type of policy or you can only do it this way. Whereas when you actually take a step back and you say, okay, I'm not necessarily worried about all of my consumer activity being covered through my policy. What if I just use my policy for uh, in investing in a place that's actually creating value for me? And if I do that, then a lot of these things that become an issue. In other words, if I'm doing that, I don't need to worry about the interest rate arbitrage between what I'm earning on my asset versus what I'm accruing on my loan. If I do get that, then great. That's an extra layer that benefits me. But as an example, I talked earlier about when I create that cash flow and I'm flowing it back. Well, part of that is going to pay the interest on the loan, right? Well, when I'm doing that, I'm flowing that money towards the loan. I end up paying simple interest on the loan. So let's just use an example. Let's say I'm paying 5% on my loan and I'm earning 5% in my cash value. Okay. So you would think, well, that's a wash. But in reality, because I'm paying simple interest while earning compound interest on the other side, I end up earning a lot more in terms of dollars and cents in my asset side, the compounding growth side, compared to the simple interest on a decreasing value on the loan side. So it by using it with investing, and so in this case we call it the investment optimizer, by doing it that way, I'm creating a lot more value and doing it in a way where the return that I'm getting, I'm just amplifying that as opposed to just counting on this arbitrage or whatever with the infinite banking.
Okay. So, you mentioned that there were six core benefits, and we've talked about a little bit about capital preservation, cash flow, use of leverage. Tell us more how this particular product helps us preserve capital. And you even
Yeah.
mentioned like estate planning, predator protection.
Yeah.
Help me help the audience
Sure.
understand that.
Yeah, great question. We go out of our way a lot in places to create asset protection, right? So when in our real estate investing, we create LLCs and we have insurance and we have all these different things to help us. Well, one of the cool things about life insurance, the cash value life insurance, is it has an inherent asset protection that comes with it. In other words, if I'm sued and I have money in sitting in my cash value policy, they can't get at it. I don't have to build extra layers of LLCs or trusts or other things around it. The insurance policy by itself, maybe another way to put that is the the government, they want to incentivize us to have life insurance. And in order to do that, they've given these tax benefits, this kind of asset protection benefit. And it's, state by state. So you want to understand in your particular state how much asset protection it provides. But in most states, all the money I have in that cash value is 100% creditor protected.
Okay. And then how does that help with estate planning then?
Yeah, great question. Life insurance is unique in the way that it helps with estate planning because there's this extra death benefit, right? So in the example I said earlier, well, what if I'm putting $100,000 a year in? Well, immediately, as soon as I put that first 100,000 in, I have a death benefit of, let's say, 3 million, right? Now, relatively speaking, that's a small number and that's intentional. Like I said earlier, we want to keep the costs as low as possible. So relative to the amount I'm putting in, the amount of insurance, if I was putting 100,000 in term policy, I might have whatever, 15 million or something of insurance, right?
Mm-hmm.
In this case, we're keeping those costs low. Therefore, maybe it's three, but the point is it's three, right? If I died the very next day, there's $3 million that pays out to my family. And that helps. When we talk about estate planning, there are a lot of different angles to that. Part of it is estate tax planning. If all of my plans and my dreams come true and I'm growing my wealth and I get to a place where I'm above the estate tax limit, and now all of a sudden my kids are going to have to start paying estate taxes. Well, life insurance is a great way to help with that. It's an immediate influx of cash. They don't have to go start selling off assets to have the cash to pay the tax. But for other reasons, like if I am passing on real estate, if I'm passing on a business, that these things that take cash to make them run, and I have life insurance that pays out. There's liquidity there that now my kids, my heirs have access to help run those things again without just having to go off to and start selling some of those assets.
So to sound that back, it sounds like somebody who is you could utilize the whole life insurance policy to create wealth, right?
Yep.
Put $100,000 in, whatever that dollar amount is, and heaven forbid something happens to you, the very next day, um, you know, for lack of being very morbid, that's a very huge rate of return.
Right. Yeah.
That's but even over the long term, right? We want to use this policy for investing and to take money out of the bank, put it in a protected environment.
Mm-hmm.
But also, it sounds like there's a strategy here for people who have a larger net worth in order to transfer wealth in a tax-free scenario. Did I
Yeah.
get that right?
Yeah, that absolutely. There are a lot of people who do it that way, and unfortunately, in kind of you listen to the gurus out there, and they say, oh, well, you only need life insurance while you're working, and so it can replace your income and all this kind of stuff. Well, I'm here to tell you there are a lot of other reasons why life insurance is valuable, and again, especially as you grow your wealth and you get into some of those upper tiers. I mean, there are people, with hundreds of millions of dollars in insurance because their assets are growing and moving in that direction, and so they need that liquidity as part of what moves on, and especially when you get into this whole idea of generational wealth. And so now you're setting up trusts, and the trusts are indicating to your children what they should do with the capital in there. And then you have this influx of insurance that then provides that ability to do that. Or if you have a business owner who has partners, and if one partner passes, then that has obviously a detrimental effect on the business, and they need to be able to buy out the now deceased partner's spouse or whatever. So there are a lot of uses for life insurance. And so what happens is, as we're working with our clients who are business owners, for example, then they'll say, okay, great, I need the life insurance anyway. Oh, and then I can do it this way and be able to utilize it. And so I'm not just it's not just a premium I'm sinking into it. I get a lot more value out of it by using it in as an investment optimizer.
Well, and I hear that as a big objection for people that keeps them from getting into the space. Is that, why get one of these policies because, I'm front loading the premium and it's just going to be a huge expense. I would never
Mm-hmm.
recoup that. What would you have to say with somebody with that type of mindset?
Yeah, it's a great question. And that's why I've emphasized along the way that when I talk about a 5% return, that's net of costs. And to your point, that doesn't all happen up front. I have costs, that initial 100,000 going in, I might only have, 70,000 of it or something in my cash value in that first year. But then the next 100,000 I put in year two, I'd have 85,000 of it landing in the cash value. And from year three onwards, as I'm continuing to put the 100,000 in, then I'm getting 100,000 plus increase in my cash value as I go. So, uh, even though I say we're minimizing costs, the fact is that exists. And so you have to look and plan on using it, right? So if someone's only going to be in the passive investing space for another 5 years or something, then it may not make sense. But if they're going to be in longer than 5 years, which most of our clients are for the foreseeable future, right? 5, 10, 20, 30 years, that's creating the passive income for their retirement and financial independence and all these things. So in most cases with passive investors, it does make sense to use it in the long term. And again, in that webinar that I mentioned earlier, we use an example. We show an example of a real estate investor who invests first in syndications and then later in their own properties, where they're putting 100,000 a year aside for 5 years, and then we do a side by side comparison. If you put that 100,000 a year into the policy, like the way I've described it, compared to if you put the 100,000 a year into just a regular savings account, and we're investing through that, in the long term, in this case, 20 years later, what's the difference? Well, there's actually a $2 million difference in value for the person having used the investment optimizer versus the person using the savings account. And that difference isn't immediate because, as we just discussed, the person with the savings account actually has more money to invest immediately, right? So you do take that hit, and I just think of it like startup cost for a business, or, if someone who flips properties, you're putting a bunch of cash in up front, counting on, the idea that you'll be able to turn the property over and turn a really cool profit. A similar thing here. It's much more predictable and consistent because of the asset we're using, but the mindset going in is very similar.
Hmm. Well, Rod, thank you so much for your time here today. I know we have some questions piling up in our chat. Guys, if you're here live and you have questions, make sure to go to the Q&A box, put your question there. I am about to moderate our Ask Me Anything session with Rod. Rod, before we go, let's leave the audience with just kind of like the biggest takeaway that you want them to have.
Yeah, if this sounds interesting at all at any level, then I would just recommend go to investwithbenefits.com. We have a webinar there on the investment optimizer. And we also have some cool material that you can download. We did a virtual summit last year with Sharon Lechter, who was the co-author of Rich Dad Poor Dad. And so you can access some of that content as well. So we're very much education oriented in what we do. We kind of have to be. The loudest voices in the room are telling you to put your money in 401ks or go do all these other things. And so what we're doing, our message is quote unquote off the norm, but it's hugely valuable and can help people accelerate their wealth building in ways that just doesn't come obvious or natural. And so we're very much education oriented. We want to help people see how to apply the 6 principles we discussed and how, for example, in this case, the investment optimizer helps you to do that.
Awesome. Rod, thank you so much for joining with us today. You've already told people where they can find you at Invest with Benefits. Guys, if you're here live, don't go anywhere. We're about to start our Ask Me Anything.